China just hit U.S. exports with a 125% tariff. But that's not the real story. The real story is what happened next. After cutting off the dollar, rerouting trade, and making moves so quiet, so calculated, that by the time Washington reacts, it may already be too late. Because this isn't just retaliation. It's decoupling. And it's happening faster than anyone in the West is willing to admit. On April 10, 2025, China imposed a sweeping tariff on American automobiles, tech machinery, and semiconductor parts, industries that brought in over $36.4 billion in U.S. export revenue last year, according to Commerce Department data. The decision came just 72 hours after President Trump announced $88 billion in new tariffs on Chinese EVs and rare earth minerals. Bloomberg analysts called it a precision strike, not just economic pushback, but a strategic message. Wang Yong, senior advisor at Ping University, put it plainly, China is targeting industries with political leverage, especially in swing states. This isn't defensive anymore. It's surgical. The market reaction was immediate. Tesla halted shipments to China. Deere & Company lost $2.1 billion in market value in just 2 days. U.S. soy futures fell 4.3% on fears of broader retaliation. But under the surface, something far more significant is shifting. This wasn't just a tit-for-tat. It was a repositioning. A signal not of resistance, but of exit. While headlines focus on tariffs, the real shift is structural. According to China's State Administration of Foreign Exchange, Beijing slashed its U.S. Treasury holdings to $668.6 billion in Q1 2025, a 15-year low. But that's just the start. China Construction Bank and ICBC have reportedly stopped issuing new dollar-denominated loans for state-owned projects, pivoting instead to RMB or euro-backed financing. Reuters confirmed this as part of a broader internal insulation strategy designed to reduce exposure to the U.S. financial system across trade, banking, and commodities. This isn't about hedging risk anymore. It's about controlled decoupling. Goldman Sachs Asia economist Maggie Wei warned that China is orchestrating a soft retreat from dollar-linked liabilities to preempt future sanctions. They're not waiting for the next tariff round. They're preparing for the long game. And the language tells the story. On April 11th, China's Ministry of Commerce used a curious phrase in its official statement. Certain U.S. imports were now deemed no longer commercially viable. It may sound bureaucratic, but it's anything but. The wording is deliberate. By framing American products as economically inefficient, rather than politically undesirable, Beijing avoids WTO blowback while sending a clear signal to Chinese firms. Walk away. And they are. Just days after the announcement, BYD scrapped a $500 million sensor deal with a U.S. supplier. According to trade law expert Henry Gao of Singapore Management University, this kind of phrasing acts as a regulatory green light for disengagement, masking decoupling as market rationality. So what happens when market-based decoupling becomes the new normal? Behind closed doors, even U.S. allies are hedging. In March 2025, Germany's BASF signed a €7.2 billion expansion deal in Guangdong, their largest investment outside Europe, despite U.S. pressure to reduce dependency on China. Meanwhile, Saudi Arabia finalized a landmark crude oil settlement with China's Sinopec, using digital yuan, bypassing the dollar for the first time. According to the Financial Times, France is now lobbying for a BRICS EU Observer Forum, while Brazil pushes to make CIPS interoperable with Latin America's regional payment network. These aren't isolated events. They're quiet pivots. Citi strategist David Lubin puts it bluntly, a multipolar trading order is emerging, and Washington is no longer the default center. If allies stop aligning with U.S. trade policy, how long before it's the U.S., not China, on the outside? America's sanctions toolkit is finite. Beijing knows it. As of April 2025, the U.S. has sanctioned more than 640 Chinese entities, according to Treasury Department records. Yet China's trade volumes remain resilient. Exports to ASEAN rose 7.4% year-over-year in Q1, offsetting U.S. losses. Meanwhile, dollar dominance is showing cracks. The yuan now accounts for 6.3% of global SWIFT payments, up from just 2.2% in 2020. And even the semiconductor chokehold is eroding. Huawei recently unveiled a 7-nanometer chip built using Chinese lithography tools and Dutch equipment stockpile before export bans, stunning analysts at Tech Insights. The irony? Sanctions are accelerating China's domestic innovation. As former U.S. Trade Representative Robert Lighthizer admitted at a Heritage Foundation briefing, we underestimated their capacity to work around us. If sanctions are backfiring, what's left in the White House arsenal? Wall Street isn't waiting for Washington to blink. It's already pricing in the pain. On April 10th, the Dow Jones Industrial Average plunged 1,000 points, wiping out $520 billion in market value after China's retaliatory tariffs slammed U.S. agriculture, industrial machinery, and EV components. Archer Daniels Midland dropped 11% in just 2 days. Deere & Company and CCR warned investors that over $3.2 billion in China-bound inventory could face immediate disruption. Meanwhile, Goldman Sachs slashed its Q2 U.S. GDP forecast from 2.3% to 1.5%, citing both direct exposure to retaliatory tariffs and indirect drag from collapsing export demand. Former Treasury Secretary Larry Summers told Bloomberg Surveillance that markets are flashing a message the administration hasn't fully grasped. This isn't just a trade dispute. It's turning into an economic firebreak. But what happens when corporate America wants a truce, while Trump's base still demands escalation? Xi Jinping isn't aiming for a quick win, he's playing the long game. Since 2021, China has increased domestic semiconductor production by 34% annually, according to the China Semiconductor Industry Association, while slashing U.S. soybean imports from 32 million metric tons in 2018 to just 9.4 million in 2024. USDA data shows Beijing has secured multi-year grain deals with Argentina and Kazakhstan to buffer supply shocks, while sovereign food reserves are up 18% year-over-year. In April, PBOC Governor Pan Gong confirmed that China's foreign reserve portfolio is actively shifting away from dollar-heavy holdings, reinforcing financial insulation from U.S. pressure. Meanwhile, Trump faces an economy where inflation expectations ticked up to 3.1% in April, according to the University of Michigan's Consumer Sentiment Survey. As strategist Kevin Rudd noted in Foreign Affairs, Xi's timeline isn't 2025. It's 2050. The contest isn't about who hits harder. It's about who bleeds slower. Right now, American farmers are bleeding. According to the American Farm Bureau, over $8.6 billion in agricultural exports to China are at risk this year, primarily soybeans, corn, and dairy. Iowa-based Cooperative Land Dues reported a 37% drop in forward contracts with Chinese buyers this spring. Meanwhile, during Walmart's April earnings call, CFO John David Rainey warned that input costs tied to tariffs are already pushing up shelf prices across core essentials. The Bureau of Labor Statistics confirmed a 0.6% monthly increase in food prices in March alone, driven largely by import shocks. This isn't theoretical. It's showing up on receipts. This isn't just a rift, it's a redesign. According to the IMF's April 2025 Global Economic Outlook, world trade is splintering into regional trust zones. China now leads a bloc that accounts for 33.6% of global GDP by purchasing power parity, surpassing the G7's 29.9%. Cross-border investment flows between the U.S. and China dropped 58% year-over-year, according to Rhodium Group data. Chinese tech giants like Xiaomi and Huawei are redirecting manufacturing expansion to Indonesia, Egypt, and Mexico. On the U.S. side, Congress is weighing legislation that would ban federal pension funds from investing in Chinese equities, a signal of accelerating definancialization. And yet, there's no coordinated strategy to reverse the trend. As Morgan Stanley chief global economist Seth Carpenter put it, we may be past the point where the two economies can fully reintegrate. We're not watching decoupling, we're watching divergence. If the old system is gone, what's replacing it? Let's be clear, this is no longer a trade war. It's a strategic unraveling, one thread at a time. China is slamming the brakes on dollar dependence. U.S. firms are being carved out of supply chains. And Wall Street? It's reacting in real time because the old rules no longer apply. But the real warning shot didn't come from tariffs or treasury sell-offs or retaliatory bans. It came quietly on April 5th when China's central bank confirmed it had completed a cross-border energy transaction using the digital yuan. The deal, involving state-owned PetroChina and an unnamed Middle Eastern supplier, totaled $2.9 billion. Not a single U.S. dollar was used. According to a Financial Times insider brief, the transaction was fully verified. And it moved fast. If China scales this model and links it to systems like CIPS, BRICS Pay, or emerging oil trading platforms in Africa and Latin America, won't just bypass the dollar. It will redefine the currency of consequence. So here's the question we're leaving you with. If Beijing forces the next generation of trade to clear in yuan, does Washington even get a seat at the table? Drop your answer in the comments.